Hello, today I'm going to be going through the part 2 of partnership accounts, and today's focus is going to be on current accounts. Okay, so if you've had a read of part 1, in part 1 we looked at the introduction to partnerships, benefits, the drawbacks, the rules on if there is an agreement in place, if there's no agreement in place, and I introduced to you the adjustments for partnership, which is done through appropriation. Okay, and we covered the interest on drawings, interest on capital, salaries, and profit split. Okay, so all of that was to do with the income statement side of things, what we call appropriation, and that comes under the income statement. So what I mentioned in part 1's video was the adjustments that you carry out in appropriation. Okay, the double entry for that is somewhere else. Okay, and today's focus is looking at those adjustments that go into appropriation. Where else do they go? Okay, and they will go into something called current accounts, and that is what today's focus is on. So just to get you started off with, what you will know by now is a statement of financial position. Right at the bottom you have the finance by section. Okay, so for a sole trader you have capital, profit, and drawings. Okay, and you know that capital is the money invested in a company. If they make a profit, investment goes up, and if they take cash out of the business, then the level of investment, the capital employed or closing capital, comes down. Okay, so capital is investment, profit increases the level of investment, and drawings reduces the level of investment in a company. And that is for a sole trader. And for a partnership, because they both have unlimited liability, it works the same way. Okay, so for partners you have something very similar. Okay, so think of it like this: a sole trader's capital account. Okay, now I know when I've covered sole traders and when I've taught it to my students that drawings is a separate T account. Okay, it has its own ledger, and capital has its own ledger, but for the purpose of this, just try and understand how a sole trader's level of capital works. Okay, so obviously capital is a credit balance, so you start off with a credit balance on the right hand side. Profit increases the level of investment, i.e. overall capital. Okay, so if a sole trader makes a profit, capital goes up, the overall capital increases. If they have made a loss, then the level of capital comes down, and if they take cash out of the business, the level of capital comes down, and overall you have your balance carried down on the debit side. For the next period it appears on the credit side. Okay, so that's how capital works. Profit increases, loss decreases, and drawings decrease. Okay, and if you understand this concept of increase and decrease and what affects capital or investment, then the partnership, the understanding for partnership accounts becomes much easier. So what are current accounts? Okay, they are, if you were to Google partnership current accounts, the most common thing that comes up and how others describe it is as a workings account. Okay, so for partners, because a business can have a minimum of 2 to 20 partners, because there are regular transactions happening, okay, it is best for these regular transactions to go into a workings account. Okay, an account where you can post transactions to on a regular day-to-day, weekly, monthly basis. Okay, so in partnership accounts, there is a choice. Okay, there is a choice. Now remember, partnership accounts don't follow any legal requirement. They don't need to follow accounting standards. Okay, all a partner needs to do is calculate their profit, and they do a tax return. So for sole traders, there is no formality. We covered this, we covered this in the previous video. For sole traders, there is no formality in terms of accounts. For partnership, there is no formality in terms of accounts. So really, this is really just a guide for you. Okay, and from a theory perspective, it is obviously recommended to follow this. And obviously, this is based on the AQA spec, AQA 7127, the new AQA spec from September 2017. Okay, and so you need to understand the theory. Okay, so for a partnership, because they have regular day-to-day transactions to do with the partner specifically, it is best that all of these transactions get posted to an account as a workings account. What you don't want to be doing in a partnership, preferably not, is every time there is a transaction, every time a partner takes money out, or they are rewarded for interest on capital, okay, or there is a share of profit, you don't want to keep altering the capital account. Okay, you don't want to keep changing capital, because as you will know already, a capital account is generally fixed. It can change, but it shouldn't change regularly. So we want to keep capital. We want to keep capital as unchanged as possible. Okay, and so therefore we have a current account to put all of our regular transactions in. Okay, and you'll see what that looks like in a moment. So the first point, the current account is for partners. Each partner will have their own current account. They will have their own, and anything that is regular will be posted in there. Okay, and we said the reason for that is because capital can therefore remain fixed and unchanged. Okay, now a current account has, in principle, it follows the same method as a capital account. So current account and capital follow the same principle in terms of debit and credit. So if we go back, a capital account will increase on the credit side and decrease on the debit side. A current account works in the same way. If a partner benefits, then there will be an increase or a posting on the credit side if they benefit, and if there is a current account transaction where they lose, then the posting will be on the debit side. So a current account works in the same way as a capital account in terms of debits and credits. So we have an increase to the current account balance and a decrease to the current account balance. Okay. Now, one thing to note is the last point here, which is partnerships. They can choose to have a current account or not. Okay, so you may see some AQA questions or any other examination board where they may mention the partnership have agreed not to have current accounts, or the partnership have agreed to have current accounts. So how does this work? Well, quite simply, if they aren't going to have a current account, then you put everything into capital. However, if they want a current account, then regular transactions go into the current, and capital is used for capital, what it has always been used for in terms of in the level of investment in a company. Okay, so let's have a look at the current account. This is an example of what a current account looks like. Okay, so like I mentioned to you before, we have an increase. Anything on this side increases, anything on the debit side decreases. Let's have a look. Okay, The first thing I'm going to highlight is balance brought down. Now you can see balance brought down is on either side. Okay, this is a bit like an overdraft. Sorry, a bit like a bank account. Okay, with a bank account, you can have money in the bank. I'm going to have to switch this up. Okay, so with a current account, with a bank account, you can either have money in the bank or you can have an overdraft. With a current account, you can either have a positive or a negative balance. Okay, so for a current account, if a partner is owed money from the business, i.e. they have a positive balance, it is on this side. Okay, so a positive balance is where they have, where the business, where the partnership owes them. Okay, and don't get this confused between a liability. Okay, so a partnership is unlimited liability. The partners and the business, they are all one. Okay, if the partnership was to fail and assets were required to be seized to offset debt, a partner is responsible, fully responsible. Okay, I mentioned in the previous video. Sorry, I mentioned in the previous video on part 1. Obviously, for the understanding of partnerships, try and just think of them as they're not separate, but try and think of them as separate parts. They're not separate entities. Think of them as separate parts. That will just help your understanding when it comes to partnerships. So in terms of here, balance brought down, let's summarize. So balance brought down, positive balance is where a partnership owes the partner, and a negative balance, okay, negative balance is where the partner owes the business. So for example, if the partner has taken so much money out, more than what they have in their current account, then they will owe the business. And if a partner has been very good and they've kept all their money in the company, then the partnership will owe them. So you have a positive and a negative. That one is a little bit tricky to understand, but hopefully with some practice you'll get the hang of it. Okay, the rest of them are very, very straightforward, so I won't take too much time on this particular area. Okay, ask yourself a question. If a partner received a profit, is that a positive increase or a negative decrease? And your answer will be a profit is an increase. Okay, it is a positive, it increases. If a partner receives a salary, okay, it is a positive to them. Each partner will have their own current account. So if they have a profit share, it is an increase. If they receive a salary, it is a positive, an increase. If they receive interest on their capital, it is a positive, an increase. However, if they take money out of the business and they are penalized for that, okay, they are charged interest, it reduces their current account balance. If they take cash out of the business, it reduces their current account balance. And if they make a loss and they have a share of those losses, it reduces the level of their current account balance. Okay, and likewise you can have balance brought down on either side, you can have carry down on either side also. So anything on the credit side increases, anything on the debit side reduces. Now all of these things in here, I mean, like we have, that's from appropriation, salaries from appropriation, interest on capital, interest on drawings, they are all from appropriation. Okay, the only one that is not from appropriation, that's even from appropriation, okay, profit loss share. The only one that isn't from appropriation is drawings. And simply because if a partner takes money out of the business in terms of drawings, their profit doesn't change. Okay, profit is income and expenses. Profit is not affected by drawings. Okay, but drawings is one of those things that comes into the current account. Okay, and the reason for that is because a partner can take money out as and when they wanted, every day, every week, every month, or at the end of the year, whenever they wanted to take cash out. Because it's a regular transaction, it comes into the current account. Okay, so in summary, a current account is a workings account. Any regular transactions that relates to a partner, will come into a current account, the credit side increases and the debit side reduces. Okay, and the objective here is when you have a question, you pick out what you need, you put it onto the right side, and you balance off the account. Okay, now obviously some of you may have the question, well, what happens to what is a capital account for partnerships? Okay, if everything goes into the current, what happens to capital? For now, understand that capital accounts, all they have in there is the normal opening capital and additional capital introduced. Okay, opening capital, and if there is any permanent injection of capital, then that is for the capital account itself. Okay, so for every partner in a partnership, we'll have two types of accounts. They will have a current account and they will have a capital account as well. Okay, very important to understand that for every partner in a partnership will have a capital account and they will have a current account. The capital is fixed, it will not change. It can change, but most of the time it will not change. And the current account will regularly change. Okay, and it's just to make things more distinguished. Capital remains generally unchanged, and the current account can regularly change. Okay, so let's have a look at a question. You may want to pause the video at this point and have a go at the question. As always, on the following slide, there will be the answers to this question. So feel free to pause the video now if you want to have a go at it yourself. Okay, so I've just on this particular slide, I have put the key information at the top to the scenario, and I've put the current accounts underneath if you wanted to see both on one page, so it's all there in front of you. So what I'm going to do is I'm going to talk you through this particular question, which is where we have information from appropriation as well as other bits. They're not all from appropriation. All we need to do is put this into the current account. Okay, that is our task. So let's have a look at the next slide where I've put the answers together, and then I can talk you through how we got to that. Okay, so what I'm going to do is I'm going to refer to the top section and then pinpoint where that information goes. So salaries, if you recall, salaries is a positive. It benefits partners, hence that comes onto the credit side. So you've got your increase and your decrease. Okay, increase on the credit side, decrease on the debit side. Salaries positive, we put them into here. The next one on the list is capital account balances. Now that actually has no relevance to this question. This question is about a current account, nothing to do with capital. Keep them separate, so the second line we can ignore. The third line, interest on capital, we've got three figures for Amy, Bob and Kaz, and we can put them straight in. Interest on capital is where the partnership pays the partner, and it is a benefit. It is an increase, so that comes into the credit side. Then we have drawings, which reduces current account balances, hence we put them onto the debit side. Then we have interest on drawings, which is a penalty for partners for taking money out, and that is a decrease, and we put those onto the debit side. Okay, so we have salary increase, interest on capital increase, drawings decrease, interest on drawings, which is a decrease. The next point is profit for distribution to the partners after appropriation. So what they're saying here is, look, we know what the profit for the year was. We've taken off all of the salaries and the interest on capital, and we've added back interest on drawings. This is now for partners to share out. Okay, this is profit for distribution towards partner. So Amy receives 50, Bob receives 30, and Kaz receives 20. So 43 times 0.5, 0.3, 0.2. And your breakdown is here, 50, 30, 20 split. Okay, and obviously your profit share is a positive. And then all I have done is I've added the totals. So balancing an account, once you have all the information in there, you total them up, you take them across. And if we have a quick look at this, obviously that 20, 30, 33, 35, 37-ish, 21, 24, 34, 35, 36, it's about £37,000. So you put it onto the credit side, take it across, difference above. Okay, the next one for Bob, if you look at those three figures there, you're looking at roughly, they're very, very similar if you compare the sides. Obviously this is 28,785, so you put the total in, you take it across, and the difference above. And for Kaz, clearly the credit side is higher, about 10k, put the 10k in. Okay, I've made an error there, so that needs to be £10,000 as well. Okay, so again, just make sure you've corrected that. So £10,000 there, and the difference above, and obviously those two will add up to your 10,000. So ignore that there. Okay, so and then you've got your carried down, transfer brought down. Pretty straightforward stuff that you should be comfortable with at this point. Okay, so that's a question on current accounts. Another question. So you've got some information there. I think on the next slide I've done something similar to the previous question. So if you want to pause the video now, feel free to do so. You have the information for the current account question. You've got Uma, Val, and Win. You've got salaries that needs to go in, interest on capital, interest on drawings, profit share, and drawings for each partner. And again, all you need to do is for these figures, put them in, balance off the account. Okay, so feel free to pause the video and have a go at this question, and I will go through the answers with you now. Okay, so again, similar to the previous question, salaries is a positive increase, interest on capital is a positive, it increases the balance for partners. Interest on drawings is a penalty, so it is a decrease. The profit share, 18, which is ready to be split. Okay, so you don't need to, this is the profit that's ready to be split. Okay, so 18 based on the split on percentages there. That's not very good. I've put them on the wrong side. Okay, let me just quickly update these figures. Okay, so what I've done is I've just changed the answers. So if you have paused the video and you are checking your answers, then I hope you have continued to watch the video to review the correct answers. Okay, so just going to go through this again. We have a current account question. Balance brought down is given to us. We need to use the information above and put that into the current account. So we have salaries is an increase, interest on capital is an increase, interest on drawings is a decrease. It's a charge to partner, so it reduces the balance. You have the profit share, which is on the credit side because it's a benefit. It is an increase, and that is where I made the error. I accidentally put it onto the debit side, so please correct that. So you have the profit share, which is an increase, and then you have drawings, which is a decrease. Okay, and then you total up the figures. So UMA, credit side is higher, take it across, difference above. VAL, the credit side is higher, you add the four figures up, 26,300, take it across, carried down is your difference above. And then you have WIN, where you add the three figures up, you take it across, and the difference above. These are your carried down balances, which become your brought down balances for the next period. So if you are looking at this particular question, all three of them, UMA, VAL, and WIN, they all have positive balances, i.e. the partnership owes them. They have more money, they have a positive balance in the company, okay? Whereas if these carried down figures were here, their brought down balances would be here, which means they owe the partnership. They've taken more money out than what they should have. Had the balance brought down been on the debit side at the start of the period, then they would have owed the partnership. Okay, so understand the balance brought down on the credit side is a positive, the debit side is a negative, the credit side partnership owes them, and the debit side is where they owe the partnership. Okay, so we have another question on current accounts, and what I've probably done is put some workings together for that. Very wordy, lots of words there. Have a read of the information, and I think this particular question is really getting your understanding on debits and credits. So really the crux of the question is that you have two partners, Ross and Sam. They have their respective balances. One has a credit balance, one has a debit balance. Okay, so Ross is in credit, i.e. he has a positive, Sam has a debit, and he has a negative. Okay, and they have 5.5 each for the profit share. So you could do a quick T account, current account, put the balances in, put the profit share in, balance it off, and then put a figure in for each of them and state do they have a debit or credit balance. And I'll have a look at the next slide where we can go through the answer. Okay, so feel free to pause and have a go now. Okay, so I've just done a quick T account on Paint. Quickest thing for me, Ross 500 credit, Sam 250 debit, and they have a 5.5 profit share, so increase, okay. And if you add these two together, you have 6,000 carried down here. I should have done that perhaps, but if you add these two together, Ross has a 6,000 debit balance carried down, which means 6,000 debit carried down, which means 6,000 credit brought down. So the answer for Ross is 6,000 credit. And Sam started off with 250, so he was in a negative. However, he received £5,500, so the 250 gets deducted. So overall, negative 250 plus 5.5 leaves 5,250. Can't seem to find my mouse now. There we are. So 5.5 minus 250 leaves him with 5,250 carried down, 5,250 brought down. Okay, so they both have a credit balance. The only difference is Ross has more money than Sam because he started off with a positive, hence he is better off, whereas Sam started with a negative, so he's got to use his profit and pay that money back. Okay, and all of this is purely a book transaction. Okay, the 5.5 profit share doesn't get paid to them in their bank. It's just a T account transaction. Okay, and hopefully we'll talk more about this later. The purpose of this particular video is for you to understand what is a current account and to get things on the correct side and have the understanding of that. Okay, do you know why there is a debit balance? Do you know why there is a credit balance? The whole increase and decrease aspect. Okay, so there we have another question on current accounts. Another question, lots of practice. So again, just quickly check the next slide to see what I've done there. And the next slide I've got a model answer, so feel free to pause the video now to have a go at this question. Simply what you need to do is, like we've done on the last few questions, draw a T account, put the things in on the right side and balance it off. Okay, so let's have a look at the answer for this question. Again, just put something together quickly on Word, where we've got the key information to the question. You've got debit balance to start with, 550. Okay, interest on capital is a positive, salary is a positive, drawings is a deduction, and the profit share is a positive. Add the figures up together. They look very, very similar. That is 14, just over 15,000. And sorry, yeah, that's just over 15,000. That's 14.5. So add these three figures up, put it into the total column, take it across, and the difference is you're carried down, and then you have your brought down. So again, this particular individual, Tara, has a positive balance in her current account. Okay. Another question similar to before. Again, you may want to pause the video now and have a go at this question. For this one, you probably want to do, maybe, it's entirely up to you. You can do two separate T accounts, or you can do a two-column T account. Again, pause the video now to have a go at the question yourself. Okay, so I've put a two-column T account together, and we have the question at the bottom with a model answer at the top. So my PowerPoint is not responding, so I'm not too sure if the recording is continuing, but I'll just wait for a moment for that to stop. So bear with me if you don't hear anything for a few moments. Okay, hopefully that issue has sorted itself out now. So let's have a look at this question. I've got a two-column T account drawn up at the top and key information at the bottom. So we have two partners, Jan and Lynn, 60-40 split in terms of profits and losses. We have information at the start of the year, 6.2 and 2.850. So they're your credit balances. I would put those in first, and as I have done here, 6,200, 2.850. They are both credit balances. We have partners took drawings of 1,500 and 1,600, so these are deductions, so 1,500 and 1,600 on the debit side. And then we have a profit. The profit and loss account, i.e. the income statement, recorded a loss of 7,000. Okay, so this is a loss of 7,000 that is split 60-40. Okay, so in terms of Jan takes 60, Lynn takes 40. Jan takes more of the loss, and it's a loss, so it is a debit, 4.2 and 2.8. So 60% and 40%. The reason why we put them onto the debit side is because it is a loss. Had it been a profit, we would have put it onto the credit side. So we have opening balances, drawings, loss, share. Okay. What I've done then is I've added the figures up. So looking at this, you've got about 5.7, which means the credit side is higher. 6,200. Take it across, difference above. For Lynn, the debit side is higher. You've got just over 4,000 there, and you've got 2,850 there. So the debit side is higher, 4.4 total. take it across, difference above. Okay, Jan has a carry down on the debit side, which is a good thing. She's in a positive 500 there, whereas Lynn has 1550 negative. Okay, and if you understand this is probably a good time to actually reinforce your understanding on how these credit balances and debit balances work. But if you think about it, Jan started with 6-2. He or she took money out, and then they had a loss. So compared to what she started off with, even though she took some cash out and she had to cover the loss herself or himself, they still ended up with, where's my mouse gone? They still ended up with £500 left. So they are in positive. Whereas Lynn started off with positive as well. However, they took cash out and they had a loss. Now, they started with a positive, though the drawings and the loss together were much more than how much they had in their account. They ended up with a negative balance. So they started off with 2850, they took 1600 out, they were required to cover the loss, and it ended up them being in a negative balance. So they ended up with a 1550 negative balance. Okay, I think the next slide is going to be part 3 of partnerships, and yes, it is. So the last slide that I just quickly skipped over, I will have to put together into a part 3 section of partnerships, simply because I don't want these videos to be too long. And so I hope, in summary, for this particular video, we've looked at current accounts, what they are, how they're used, and we've looked at all the adjustments for current accounts, and I hope you've found it useful, and thank you for listening.